Oil prices have hit fresh recent highs after the European Union leaders agreed on a plan to block more than two-thirds of Russian oil imports. Before the war with Ukraine, the EU received about 40% of its gas supplies from Russia. So what does Europe do now? Welcome to this edition of IG Trading the Markets podcast. I'm Jeremy Naylor. I'm talking now to ADMISI Chief Economist and Global Strategist, Marc Ostwald. Marc, it's great to have you back on the pod today, talking about this hot topic. What does this agreement mean in your mind? Is it the success that the EU claims it to be, or will the Russian president be thinking he's managed to, in part, to dodge a bullet?
Well, I certainly think President Zelensky won't think it a great success, but on the other hand, one has to say it still is going to cause a lot of disruption. The EU is going to be buying a lot less oil. If not, it still will be buying some oil from Russia. So to a certain extent, I'd call it a small success. It's not a huge success, I think, above all. And this really comes down more as a problem for the EU than anything else, because of the lack of unity that was shown, not being on display that had been shown at the beginning of the Russian invasion of Ukraine. So it's to a certain extent a success.
Yeah, where is Europe going to go then to get the oil that it needs to run its factories, let alone cars on the roads and heating oil or gas to run various parts of one's domestic use and so forth? It's going to have to find it from somewhere, and presumably it's going to have to pay an awful lot more for it.
Yes, I mean, this is basically a problem, whether we're talking about Russian gas supplies being cut off or, oil in this particular case. The problematic that we have at the moment actually is twofold in terms of the oil market, because cutting off Russian oil is one thing. Cutting off Russian for refined products, which are the big problem in the oil market, is a much bigger one. And in that sense, yes, they will be relying more on OPEC. They will probably be relying on more imports from the US and Canada. They'll also be relying on more imports from Nigeria and Angola. And so this brings into focus another aspect of this, which is security of supply. The supply from Russia, above all pre the invasion of Ukraine, was always basically secure and was always going to be pretty plentiful. Now, if they're going to have to rely on supplies from Nigeria and Angola, which have a long record of supply disruptions, even if they're not going to be making up the lion's share, I would expect the lion's share of this to come from the GCC countries, GCC members of OPEC, Iraq, along with them. But what you have a problem with here is, above all, one for refiners, because Urals oil is the bulk of what goes into refined products, and this is sort of an important aspect which really doesn't get talked about that much, but does have implications for prices, because if it's the wrong sort of oil quality, then they bid up for the right sort of oil quality, and you get an even more fractured market, and you get even more pressure points within the oil market as a whole, as well as likely seeing some shortages in terms of refined products. And this is a broader array of things than just gasoline and diesel, though diesel is obviously the lifeblood and the workhorse of the oil markets, above all in terms of transport and logistics. So there are multiple aspects to this, and it is going to be problematic. The Russian side of the equation, I would say, well, they're also going to have to, saying that China and India can pick up the slack. Well, that's also not necessarily actually the case. Simply because if India and China would just pick up all the slack from the European demand, or what Europe was importing previously, they would basically have to utilize pretty much their whole tanker fleet to import that, which seems pretty unlikely. So that means we're going to have a shortage of supply in the world. We're going to have displacement, and European refiners are basically going to be on call, basically, to try and find some way around the refining problems that are going to come about.
This sounds like it's all going to be extremely expensive. When you get this increase in input costs, which undoubtedly is going to happen as a result of this, and this is going to feed through to prices, factory gate prices, that ultimately the consumer is going to have to bear the cost of this in increased cost of goods. Where does all this end in terms of inflation, interest rates, the outlook for economies, potential stagflation? As an economist, where do you see all this ending?
Well, I think most people had hoped that some of the energy supply problems, and they've been multifold and not just related to the Russian invasion of Ukraine, would start to ease in the latter half of the year. This would seem to suggest that hope may be a forlorn one. Certainly in terms of prices coming down, they're more likely to go up. And therefore, those pressures that are there and are becoming ever more evident, above all for European consumers. And from a multiple aspect, remember that oil is obviously a key provider of all the plastics that we have. And so even those sort of things are going to see knock-on effects from this. So it is highly problematic. The real problem with energy price problems, if you talk about agricultural price problems or other raw materials, the problem with energy prices is it affects all the other commodity prices. Because at the end of the day, they have to be transported, they have to be processed somewhere along the line, and somewhere along the line, given 82% of the world's power comes from hydrocarbons, and this is what we're talking about, then that creates a problem for everybody. So it's not easy. And on the other, the sort of counter to this is at the same time we've got all the drive towards renewable energy. So it's some very, very tough choices here. And ultimately, yes, the consumer is the one who's going to end up being on the hook for it. It sort of really does actually remind us that in terms of central banks, when we're looking at this, this is a situation, a supply side problem for raw materials, be that energy or other commodities, is basically a problem which is more readily solved by fiscal and legislative measures rather than the blunt instrument of basically trying to kill off demand via interest rate hikes, because it doesn't solve any of the supply side problems. And the bigger problem is basically it's a lack of investment in infrastructure. I mean, it's a very simple comparison to understand why we've got to this situation. Oil and gas upstream investment between 2011 and 2016 was about $750 billion per annum. Then we had the oil price crash of 2015, so it dropped basically to $400 billion per annum. And yes, it is picking up now, but you don't create refineries, you don't create more oil fields which are pumping more oil, at a flick of a switch. So this is a problem which is going to last at least a couple of years by the time we actually get round to putting everything in place that we need.
So you're talking there about presumably the involvement of governments rather than central banks to try and help on that side of things. We know from the UK's experience just recently, this decision to go down this idea about putting a one-off windfall tax on energy companies, for example. Do you see more of that happening across the world? Do you see more of the sort of the Robin Hood type government strategy trying to poach from one part of the balance sheet to pay down another part? Is that more of what you're going to see? Or do we go back to quantitative easing? Do we have more governments trying to create more money to feed it back in once again to the struggling consumer? How does all this resolve?
Well, okay, the UK government has put some measures in this windfall tax, which basically say if you invest more, then we will let you off some of that windfall tax. Whether they've got the balance right is anyone's guess. Generally, windfall taxes are regressive. They don't actually achieve the results that people want. And they also neglect the fact that actually some of the big windfall gains that oil and gas companies have made over the last year as prices rose, that neglects the fact that in the previous year, in the peak year for the pandemic, they actually lost all that money, about the same sort of amount of money. So it actually, at the end of the day, it may not encourage the sort of investment. And at the same time, the oil and gas companies are going to be turning around to them and saying, well, hold on a minute. On the one hand, you want us to focus much more on renewable energy, and now you're telling us we need to do more so that the supply of oil and gas is better. So somewhere along the lines, governments need to make up their minds. And they're tough choices. I'm not saying these choices are easy. But they do have to make up their mind what their particular strategy is, rather than going for gratuitous, but nevertheless probably quite popular, for those who are not actually thinking it through to the end point, windfall taxes, largely basically to say, look, we're trying to, that governments are trying to say, we're trying to help the consumer, without actually at the end of the day probably achieving very much in that particular direction. So to some extent, it is just going to create a lot of demand destruction, which isn't actually particularly good news for any economy.
Well, then, of course, you get to the situation where we have falling growth. We've already seen evidence of this in GDP data out recently, where growth is, in some cases, now contracting. If we're going to get more of that and we don't get any let up in inflation, that's stagflation. We're hearing, and we keep hearing, how bad that is for economies around the world. Where does it stop? What's the break point, or the circuit breaker, if you like, to stop this happening? Is there something governments can do?
Well, the first thing they could do is basically provide a lot more investment in infrastructure. One of the UK's biggest problems is basically every recession that there has been since World War II. And I picked the UK, though you could easily pick out a whole load of countries in Europe and in North America for doing exactly the same thing. But the UK just happens to be particularly acute because it's so reliant on imports of everything. But you need to incentivize investment. And part of the problem that we've had with this technology boom that we've had since the end of the Cold War is a lot of the money basically hasn't gone into infrastructure investment, and it should have. And now we're starting to pay the price. We've seen it, how fragile it all is, simply because if we are going to go to a more fractured world, a less globalized world, I'm not saying we're getting rid of globalization completely, then you need much better domestic infrastructure rather than relying on, we can get it from country X, Y, or Z. Because it's simply not going to be that easy. And therefore, you need to incentivize investment in infrastructure and actually spend more to incentivize it yourself. So you need public sector projects which beget then the private sector investment, which improves your internal infrastructure, because this is all largely about infrastructure.
Are we talking levelling up? I mean, that takes us back to talking about the UK government, and they're talking about trying to increase other areas of the country. Presumably that's the sort of thing you're talking about. We already know that HS2 is coming, and that's obviously a big infrastructure spend. Is that the sort of thing you're talking about, or are you talking about some other infrastructure spends?
That's an element of it, but basically when the utility sectors were privatized, the incentives for the likes of Centrica in this particular case, for instance, to keep all those all that storage space for natural gas was very, very low, simply because of the structure of what had been set up. I'm talking about infrastructure in the broadest sense. Yes, transport's very important. The better your transport system is, whether it be that road, rail, or air, or shipping, the more likely you are to have everything running smoothly. In the UK's case, that's simply not the case. But you can also look at Europe in terms of its energy infrastructure. It was already found out last year just how woeful it is. And it's also been found to be woeful in places like China and Brazil and the US. So this is not a problem unique to the UK, just to make that very, very clear. So everyone needs to up this, and they need to do it in the context of how do we plan this transition away from hydrocarbons? Because if we keep on not investing in it, then there is a dangerous risk that before we get to the sort of capacity and the investments in renewables which are required for that are enormous, absolutely colossal, then we're going to actually end up with oil prices in the $200 or dollar area or more, simply because no one's thought about the planning of this. And it is about planning. And along the way, there are going to be very, very difficult steps for a lot of people.
Yeah. Okay, look, Mark, I was going to end up on the price of oil. That takes us neatly then to the end of this podcast. Thank you so much indeed for joining us. I'm very grateful for your time. That's Marc Ostwald. He's Chief Economist and Global Strategist at ADMISI. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.